Hi everyone, this is Robert Weinberg, your mortgage expert and financial coach, coming to you to discuss credit strategies. Now when it comes to your credit, knowledge really is power, and it's very important that you have an idea of what's on your credit reports. The resource that I recommend for this is a free website called annualcreditreport.com. Now, many people don't realize, but you actually, as a consumer in the U.S., do have the ability to get a free copy of your credit report once a year from each of the 3 credit bureaus. And you can do that through the website annualcreditreport.com. Now, once you have your credit report in hand, you'll want to review it for any errors and make sure that what's on there is accurate. One of the biggest things that I see with those who have very high credit scores is their debt utilization ratio. So what this is the total amount of debt that you have divided by the total amount of credit that you have. And specifically, it most affects on revolving credit accounts like credit cards and charge cards. So there are certain strategic levels that you want to get to in order to maximize your credit score. The first level would be 50%. So on a $5,000 credit card, you'd want to have less than $2,500 used in a balance, or your credit score will go down dramatically. Beyond that, you want to get your debt down to 30% of the total credit limit. So on a $10,000 credit card, 30% would be a $3,000 balance or less. And the ideal ratio to have all of your credit cards at in order to maximize your score is going to be 10% utilization. So on a $10,000 credit card, you'd want to have your utilization below $1,000, which is 10%. And again, that will maximize your credit scores. The next thing is collections. So I have a lot of consumers that come to me looking to buy a home or refinance. And when I look at their credit report, they have many collections on there. And they'd say to me, Rob, I'm going to go ahead and just pay those off. And my experience is that unfortunately, once a collection has hit your credit report, the damage is done. The only way to repair your credit, so to speak, from that collection is to have it deleted. So in order to do that, you want to utilize a strategy called pay for deletion. Even if it's going to make you feel good at night to pay that account off, unfortunately, by paying it, it's not necessarily going to increase your score. Unfortunately, in many cases, it will actually lower your credit score to pay a collection off because it reinitiates the date of last activity. So the way that the pay for deletion works is if you are going to go ahead and make a payment on a collection account or pay it off, you'll want to go to the collection agency or whoever holds the account ahead of time and talk to them about the fact that you're going to pay the account off. And in order to do that, you're going to require that they delete the account from your credit report. You'll always want to get something in writing from them stating that they will delete that from your credit report. Otherwise, there's no guarantee that it will happen. By them actually deleting the account off your credit report, it will improve your credit score and make it as if that collection never even existed. Now, the next thing is inquiries. There's a huge misconception from consumers nowadays that credit inquiries, specifically hard credit inquiries, are a no-no on your credit and you want to stay away from those. My experience has been working with thousands of consumers over the years that credit inquiries, while they do impact your credit score, it's very minimal. So if you are shopping for a home loan or you're shopping for an auto, it's okay to talk to multiple lenders. It's okay to get a second opinion if you must. And you actually have a 14-day shopping window to where you can talk and have your credit pulled by multiple lenders, and it will not have a large impact on your credit score. But again, even the impact of one inquiry typically is only a few points, so it's nothing to be worried about. Now, last but not least is new accounts. So a lot of times what happens is you open up a new account, whether it be a mortgage, a credit card, or an auto loan, and your credit score has a drop initially. And the reason for that is that the credit bureaus are not really sure how you're going to treat that new account. They haven't seen it before, and they're not sure if you're going to pay it on time or not pay it at all. So there's typically a 90 to 120-day window after you open a new account to where it will have a negative effect of a few points on your credit. That's totally natural and totally normal. And after a few months of making on-time payments on that account, you can rest assured your credit score, all else being equal, will go back and bounce back from the slight negative impact that a new account will have. I hope this video on credit strategies has been of value to you. And as always, if you'd like to reach out and have a consultation with me to either buy or refinance your home, you can send me a private message via social media or call or text my office. The direct number is 860-413-3938. Talk to you soon.